On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, hope you're all well. I wanted to talk today about mortgage rates, which is something I'm getting asked about a lot lately, probably not surprising now that the OCR has started coming down. I've got good news and bad news for you. The good news is that yes, mortgage rates are headed lower, and that should take the pressure off household budgets and give many homeowners and borrowers a much needed reprieve. The bad news is that they might not fall quite as much as some of you are hoping. With that first rate cut under its belt, the Reserve Bank will have several more cuts in the pipeline. There are two more Reserve Bank meetings this year, one in October, one in November. I think you'll see cuts at both of those, and then beyond, we'll see more cuts next year as well. The Reserve Bank's own projections suggest that the OCR will settle at about 3% by early 2027. So it's at 5.25% at the moment. They see it coming down to about 3 in roughly 2.5 years' time. Now, financial markets see it getting there a little bit sooner than that. They think the Reserve Bank will end up cutting more quickly, more aggressively than its own forecast suggests. But financial markets do agree that the policy rate will land at about that same level, about that 3%. The OCR is like a brake or accelerator pedal, and it's the key tool that the Reserve Bank uses to influence the economy. So when it wants to increase activity, when it wants to boost things, it will reduce interest rates. That's like putting the accelerator down. And when it wants to slow the economy down, get inflation under control, just cool things a little bit, as has been the case over the last few years, the Reserve Bank can put the OCR up, and that's like the brake pedal. So you've got this concept of what they call the neutral OCR, and that's the level of interest rates where the economy is in balance, it's not being sped up, and it's not being slowed down. Very difficult to pinpoint exactly where that tipping point is precisely, but it's an important concept for policymakers, and it's something the rest of us need to take note of as well. Historically, the Reserve Bank has thought that the neutral OCR is somewhere around 2%, in line with its inflation target. If you ignore the pandemic and what's happened since the pandemic as we've tried to get things back into balance, that's roughly where the OCR has averaged in recent years, about 2%. In the 10 years preceding COVID, so if we ignore that oddball pandemic period and the aftermath and take the 10 years leading up to that, the OCR fell as low as 1% and it went as high as 3.5%. That was sort of the range that it was moving around within. And it averaged 2.3% over that entire decade. Only 2 of those 10 years, it was at 3 or above. So at 80% of the time, or 8 years out of 10, it was below 3%. So it largely has been around that level, or on average at least. But today, the Reserve Bank sees the neutral level of the OCR as being 2.8% in the long term. That's up from 2.3% a year ago, and it's above that historic estimate of 2%. So we've gone from thinking it was 2 some time back to now thinking it's closer to 3. The Reserve Bank's not alone. We've seen the same elsewhere. The Federal Reserve in the United States has also been revising up its estimate of the long-run policy rate. So the Fed now thinks that stands at 2.8% too, and that compares with 2.5 at the beginning of the year. So theirs has been trending higher as well. Now, nobody can exactly calculate where neutral truly is, at least not with any accuracy or precision. But most experts and most commentators do agree that it's higher than where it used to be. There's a range of factors that have contributed to that thinking. You've got globalization moving into reverse. You've got higher government debt levels. You've got demographics, an aging population right across the world. and action to combat climate change. All of those things have been contributing factors. And for the typical borrower or homeowner here in New Zealand, the upshot is that mortgage rates might not fall quite as much as you would like, because that neutral level, that steady state level of interest rates, is a little bit higher than it used to be. Over the past several years, the 1 and 2 year mortgage rates, which are quite popular ones, quite popular terms, the 1 and 2 year mortgage rates have, on average, been about 2.3 or 2.4% above the OCR. So wherever the OCR has been, the 1 year rate on average has been 2.3% above that, and the 2 year rate has been slightly higher, about 2.4% above the OCR wherever it was at the time. Now that gap was a lot wider during the ultra low interest rate period of COVID. It was probably closer to 3% or even a little bit more than that. And it's been much narrower since the OCR pushed above 5% last year. It's been, 1.2, 1.5%. So that premium can move around, but on average, since let's call it 2017, it's been about 2.3 or 2.4%. Now, we don't know exactly where that premium will go in the coming years. It will depend on a range of factors, including how competitive the mortgage market gets. However, history would suggest that mortgage rates for those popular terms, the 1 year rate, the 2 year rate, will be roughly 2% higher than the OCR, give or take. It might be a little bit less than that. It might be a little bit more than that if it's closer to that long-term average. Now, if we take where financial markets see the OCR going over the next little while, we can have a reasonable guess about where mortgage rates are going. So the OCR, financial markets see it falling from current levels, 5.25%, to 4% by April next year. Now that could change. Market views will change as different information comes to light and as we hear different things. But at the moment, the market sees the OCR being down about 1.25% between now and April. That's a big fall from where we're at today. That would imply mortgage rates of about 6%. We just take 4% plus 2%, we get to about 6%. 2 years from now, so late 2026, second half of 2026, that's when financial markets see the OCR having already bottomed out and reached that 3% low, that sort of terminal rate that it gets to. And at that point, that suggests that borrowers will be looking at mortgage rates of about 5%, which is a big fall from being north of 7%. They've been north of 7% for the most part, the 1 year rate at least, especially over the last year or 18 months. So 5% would be quite a bit lower than 7%. That's good, but it's still well above that crazy COVID era where things got incredibly low. I think at one point the 1 year rate fell as low as 2.2%, so incredibly low. Well above those levels. And interestingly, at 5%, that would still be quite a bit above the 3 or 4 years before COVID. So if 5% is indeed as good as it gets, I think the coming years will more closely resemble that post-GFC period from 2009 up to sort of 2015. Back then, the OCR moved within a range of 2.5% to 3.5%. And over that whole period from 2009 to 2015, it averaged 2.75%, which is almost bang on where the latest estimates of neutral are. The 1 year mortgage rate over that period was in that 4.5% to 5.5% range, roughly, and it averaged out to about 5%, which is interestingly almost exactly where our back of the envelope calculations have got us to. So I think that period is the one that we need to look to as more closely resembling the period that we're going into. Don't look at the COVID period, and it might be a little dangerous to even look at that period just before COVID too, because things have changed and that neutral rate is higher than it used to be. So it is true, mortgage rates are headed lower. Borrowers do absolutely have the right to feel better and more optimistic and more encouraged about what's ahead. However, don't get ahead of yourself. Things might not come down quite as much as you think, and we might not see those 3 or 4% mortgage rates again. The new 3 or 4 might be 5, 5.5, especially if that neutral rate is indeed higher than it used to be, like the central banks and a lot of experts believe. That could mean the new normal for mortgage rates will be too. All right, we'll leave it there. Thanks very much for listening. We'll talk again soon.
For more insights, visit craigsip.com.